If you're thinking about taking a personal loan in the United States, you usually have two main options: traditional banks or online loan apps, and choosing the wrong one can cost you thousands of dollars over time. Let's break this down with real data so you can make a smart decision. Traditional banks like Wells Fargo Citi and US Bank typically offer personal loans with interest rates ranging from around 7% to 25%, depending on your credit score, with the average borrower paying close to 10 to 12%. APR banks usually require a credit score of at least 670, and the approval process can take anywhere from 2 to 5 days. Banks are highly regulated, which makes them safer and more predictable for long-term borrowing. Now let's look at online loan platforms like SoFi, Upstart, and Lending Club. These companies use technology and in some cases AI to approve loans faster, often within minutes or within 24 hours. They also accept a wider range of borrowers, including people with lower or limited credit history. However, the trade-off comes in the form of higher interest rates, which can range from around 6.5% for highly qualified borrowers up to 36% APR for higher risk applicants. Some platforms may also include origination fees, which can be 1% to 8% of the loan amount, increasing the total cost. Now let's compare them directly using a simple example. If you take a $10,000 loan from a bank at 12% APR over 3 years, you might pay roughly around $2,000 in total interest. But if you take the same loan from a high-interest loan app at 30% APR, you could end up paying more than $5,000 in interest. That's more than double the cost for the same amount of money. This is why understanding the total cost of borrowing is more important than just getting fast approval. Banks are generally better for people with strong credit who want lower interest rates and predictable payments. Loan apps are useful for speed and accessibility, especially if you need money urgently or have a lower credit score, but they can become expensive if not used carefully. So, which one is actually better in 2026? The answer depends on your situation. If you value lower cost and can wait a few days, banks are usually the smarter choice. If you need instant access to money and don't qualify for traditional loans, then apps can be helpful, but you must check the APR fees and total repayment amount before accepting any offer. The smartest borrowers don't just look at how fast they get money, they look at how much they will pay back in total, because in personal finance, speed can feel convenient, but cost is what really matters. So before you take your next loan, make sure you compare both options carefully and choose the one that saves you money, not just time. Before you take any personal loan, there are a few important things that most people ignore, and these small details can make a huge difference in how much you actually pay. First, always check the APR, which stands for annual percentage rate. This is not just the interest rate, it also includes fees and other costs. Many people only look at the monthly payment, but the APR shows the real cost of borrowing. Second, look for origination fees. Some loan apps charge between 1% to 8% of the loan amount up front. So if you take a $10,000 loan, you might lose up to $800 before you even receive the full amount. Third, understand the repayment term longer. Loan terms may look attractive because of lower monthly payments, but they increase the total interest you pay over time. So a smaller monthly payment can actually cost you more in the long run. Fourth, always check for prepayment penalties. Some lenders charge extra fees if you try to pay off your loan early, so make sure your loan allows early repayment without penalties. Fifth, avoid taking multiple loans at the same time, because this can quickly damage your credit score and increase your financial burden. According to financial experts, one of the biggest mistakes borrowers make is not comparing multiple lenders before taking a loan. Even a small difference in interest rate can save you hundreds or even thousands of dollars over time. Also, keep in mind that your credit score plays a major role in determining your loan terms. A higher credit score can help you get lower interest rates. So, improving your credit score before applying for a loan can be one of the smartest financial moves you make. At the end of the day, borrowing money is not just about getting cash quickly, it is about managing your financial future responsibly. The difference between a smart borrower and a careless one is simple. One compares the total cost and the other only looks at how fast they can get the money. So always take your time, read the terms carefully, and make a decision that saves you money in the long run.